Accounting statement carry informations. This lecture shows you how do you work with those financial statements using ratio analysis to make some judgment calls. We're going to working on first is how you're using standardized financial statement and make some comparisons. And how do you compute and interpret some financial ratios, particularly the company's profitability and its growth potential. For this lecture, we also require you learn some basic skills with Excel spreadsheet, particularly how to use a formula. I'll discuss this one later in the homework assignment 15. Now, let's do the common size analysis first. Assuming you are hired as the new manager for a company. Now, you need to think, first thing you need to do is how the company's doing. So people give you the latest 5 years financial statement, for example, its balance sheet and its income statement. All those numbers. Now, how do you look at all those numbers which give you some kind of clue? Is the company in good shape? Is the company well managed? What do? One thing you can do is called common size analysis. Common size balance sheet, as the name suggested, no matter it's a big company or a small company, it's looking at everything, every line items in terms of its total asset. On the other hand, for income statement, you're looking at all items in terms of sales or revenues, right? Those common-sized analysis give you a very quick summary of companies' year-to-year financial condition. Allow you to compare different size, particularly from one company with the other company. So we have the words called common size because you are divided by either sales or assets. Let's do one by one. First, let's look at the company's balance sheet. The balance sheet usually, as we know, is a snapshot of company's assets. Now, most those accounting information usually will give you like more than 1 year. Here's 2 years. Is in ascending order. So it's 2015 first, 2016 next. It's in, from low to high. So 15, 16, 17, 18. But nowadays, if you download the financial statement from a website like Yahoo Finance, the order is the opposite. It's a descending order. So the first one to give it to you will be 2018. 2017, 2016, 2015. Now be careful about that. Otherwise, if you messed up with the order, you are getting big trouble. For example, let's look at this particular company. Its total asset from 3373 to 3588. Is the asset grow or decline? Obviously grow, right? 3373 grow to 35. Now, if the order is the opposite, this is year one, this is year two, this is year one, that is decline. So when you're dealing with financial statement, be careful about ordering. Okay? Now, given those, how do I, using the common size to give me some kind of digest of company conditions, you create two separate column for each year and calculate the ratios. So you create another two columns. If we call this is column A, column B, we create column C, column D. Now, on these columns, we enter one formula. We want to look at what the percentage of cash in terms of asset. So what do? We put a equation. In the cell, I put equal sign. It's a formula. Equal. Using my mouse, go to the cash position in 2015, divided by absolute value of total asset. That particular cell. Hit return. It gives me 2.5. Then I copy the formula, put all the way down to this position. Even all the way down here. Why? Because I put an absolute position of the denominator. The spreadsheet will change the numerator. So give you those ratios. All right. Now let's look at this two situation. Now this is the common size ratio. Now we will see that is a company the inventory the company there's not much changes. So one question I can ask here is, how about the company's long-term debt? The long-term debt for company year 2015 is 531. 2016 is 457. It's actually reduced. It's substantially reduced. Why? It is 3% reduced from 15.7 drop to 12.7. That can be a substantial change in capital structure. So through this kind of quick analysis, they show the debt versus the equity structure change. Now let's look at the income statement. Here we only have 1 year income statement. The top of the line is sales. The bottom line is 363. And how do you distribute these two? Those are dividend and retained earnings. Now, in order to get a digest view of the company's operation, we do a common size analysis. We divided every items in a income by the top of the line sales. We create a new cell. Sales divided by sales. Now we have 100%. Cost of goods sold divided by sales, 58%. Depreciation divided by sales, 11.9. Now, notice here you'll calculate. Now let's look at this interesting 15.7. 15.7 is the net income item divided by sales. 15.7%. What is that? That is called gross profit margin. For every $1 you made in sales, 15.7 cents goes to the company, or the rest of our cost. So it's a strictly tell you what happened to each dollars. So that's why we all see very clear as for the company, for example, profitability on that. So compared to now, we only have 1 year here. But if we have a multiple years, so we can look at, is the company's profit margin improving, or the company profit margin is decreasing? Now you can look using this one to calculate to find the company strong point or weak point, etc. In homework assignment 15, I ask you to, among all the 5 homework 15, I ask you using spreadsheet to do the common size analysis. I post a YouTube video show you how those common size analysis can be easily done with a spreadsheet. Please follow that YouTube video, which is actually a student did the homework similar to what you are doing. You only have 2-year figure. He has 4-year figures. Probably he is a graduate student, so 4 years. You do 2 years, okay? Now, for those who are not really familiar, how do you enter formulas? You probably need to go over with the tutorial on YouTube also. But for those who already know how to enter the formulas, pay attention to the absolute value. Like you divide everything by total asset. You put total asset in front of total asset, put a dollar sign in front of it. So when you copy the formula, that position become absolute, never change. Okay? So please work on this. Spend some time on that. When you turn in, I'm going to look at your Excel and make sure that you are using formulas, not just key in the numbers. The essence is you need to show me you know how to using spreadsheet do a common size analysis. Okay? It's the number one homework assignment, particularly in Excel. You do this week. All right, now let's move on to ratio analysis. There are thousands of ratio analysis. The ratio will give us a tool to make comparison from one company A to company B, or make a comparison during the time period, year 1, year 2, year 3, year 4. It's widely used internally by the management of their own performance, or externally by the financial analysts looking at what the company's problem or company potential is, the ratio analysis. I remember one of the students last week in the current event discussion panel, she posted an article on Tesla. Tesla has huge growth. I was going to reply to that post. I say, have you looked at their ratio? The ratio shows Tesla's is negative earnings, the negative profit margin, like negative 35%. But that means they are not making money. In other words, every sale they make, they're losing. Every $1 sale they make, they're losing 35 cents. Now, if the negative 35% really mean that. But those are the ratios. You can take a look. Okay. So there are so many ratios. There are key ratios. You need to know is what those ratios try to measure, and why those measures are important for different clients. The book listed the category of 5 of financial ratio. They are, number 1, is a short-term ratio, or liquidity ratio. Number 2, long-term ratio, debt equity ratio. Number 3, asset turnover ratio. How do you run the company efficient or not? 4th, profitability ratio. That is important. Profitability is the most important ratio we need to pay attention to, particularly in terms of return on equities, return on stock investment. We will discuss. We're using Pont Identity to study that. Finally, is the market value ratios. Now let's do it one by one. First, let's look at that particular company. Here is the company's 2016's balance sheet. The ratios are liquidity ratio. When do you use? For example, for short-term financing applications, you're talking to your vendor. Say, okay, why don't you sell those things to us on credit? But the seller saying, can you pay me? Do I need to check your ability to pay? They might looking at your company's current ratio. Current ratio is equal to current asset divided by current liability. 708 divided by 540 equal to 1.3. That means you can, you have more current asset than your current liability. And people say, well, you have a lot of inventories. Inventory doesn't count because it takes time to convert inventory into cash. Well, how about that? Do not look at inventory. So current asset minus inventory, you get what we call quick ratio. So 708 minus 422. What left divided by 540? 0.53. That means it's not really fully covered, all the current liability. Furthermore, if people even don't want to looking at the current the accounts receivable, they want, well, how much cash you have? What is cash reserve you have? You're using cash account 98 divided by 550. Your cash account cash ratio actually 0.18. You have 18%. You can pay off 18% today. Now, which one is the right one from the lender's point of view, for the person provide your credit point of view? You want those ratio as high as possible. That means you have more cash to pay. But on the other hand, from the borrower, they don't have that many cash, and sometimes if you keep too high a cash account, you lose. It's not a very efficient way to run the money. But here just show you liquidity ratio is when used in you apply for accounts payable, a trade credit, for example, to the banker or to your vendors. It's a short-term liquidity and short-term lending and borrowing. Now, for long-term lending and borrowing, people using financial leverage is a debt. Obviously, the most famous ratio will be the debt ratio. Here we're talking about debt ratio including total debt. That means short-term debt and long-term debt, or current liability and long-term debt. Some of the ratio, in practice, some people do not looking at short-term debt. They only look at long-term debt. So be careful. Here, we are using total debt. In reality, some people are looking at long-term debt, not short-term debt. It depends, okay? Make sure that you understand when people are talking about ratio, what they are talking about. Here, the debt ratio is 0.28 or 28%. In other words, for every $1, 28 cents is a debt. Imagine 28 cents debt. Okay. This kind of ratio, also the other measurement, commonly measurement, is called a debt equity ratio. Is a total debt divided by total equity. Total debt over the equity. So in this case, it's 0.38. So you're using 540 plus 457 divided by 2591. You probably don't use this one, using those method, 0.38. Now, debt equity ratio, which one is the right ratio? It really depends. Really depends. For a home loan mortgage, for example, usually the required ratio 20% down. That means the debt ratio is 80%. That's extraordinarily high. It's sponsored by government body, Fannie Mae. For a corporation, many corporations, the ratio is 30% or 40%. The reason for using high leverage is if the economy going down, if cannot meet interest payment, then you are in trouble. You're financial in trouble, financial illiquid, right? Insolvency. So long-term debt basically is a long-term bondholder will pay attention to. The bankers particularly pay attention to. The other one is called a multiple equity multiplier. Using that, we call it financial leverage. In other words, some people call it other people's money. Using other people, you pay a constant interest rate, but all the profit you're making through your investment, as soon as you pay off the debt, all belong to you. In our discussion last week, we showed you how a company making money for the shareholders, because shareholders is the residual value. The wealth is the residual value of a company when it's pay off its debt. There is it's a movie starring Danny DeVito, other people's money, how they're using leverage to do it, right? It's a kind of risky move. So equity multiplier give you some what is the using debt will enlarge your return. We'll discuss this one later, which is equal to total asset divided by total equity, or 1 plus that equity ratio. In other words, 1.38. What that means, I'll give you some rough idea. So every 1% return for the company, because you're using that, in this case, you have 38% higher when the normal return. We'll discuss this one later when we discuss DuPont Identity. The more debt you're using, the more equity multiplier you have. Now, this is a risky move. When the rate of return is positive, you have more. But if the rate of return is negative, if a company is losing money, a high equity multiplier, a high debt, might cause trouble for the company. So those debt equity ratio or debt ratio is related with is long-term solvency. It's a financial leverage ratio. Now here is another financial leverage ratio also included will be time interest earned. So how much the banker was thinking about, okay, your earnings, how much interest covered. Here is the EBIT divided by interest payment. Or cash coverage ratio. They are using cash flows, the EBIT plus depreciation. Depreciation reduce your taxable liability, but it's not itself. It's not a cash item. You don't write off that. It's kind of a gimmick. Okay, so we add a depreciation back, which will give you the operating cash flow divided by interest rate, 6.9. Just like those ratio, a lender want the applicant have a high ratio. They want to have a high ratio because it's safe. All right. If a low ratio, I'm sorry, in this cash cover ratio, okay, they want more. All right. The third category of ratio, particularly used by internal management, particularly used in measure of the effectiveness of asset management, are inventory turnovers. Inventory turnover is cost of goods sold divided by inventory. Okay, so you look at that. So in this case, 1.3 cost of goods sold. Oh, I'm moving around. Cost of goods sold here is an income statement. 1.344 divided by inventory, which is the balance sheet items. So it's the income statement divided by balance sheet items. 3.2. 3.2 per year. You basically turn over like 3 times. Now this one usually measured in days. 365 days divided by 3.2. On average, the turnover inventory be cleared and order a new one is about 115 days. Right. The other ratio is receivable ratio. Receivables is you're using sales on credit, how much you collect, how fast you collect. Sales divided by accounts receivables is 12.3 times. How many days? On average, the receivable turnover 30 days. In other words, it's about 30 days you get your money, get your money paid back. So obviously, you want it as short as possible, right? But sometimes you need to give your customer credit for that. This is going to trade off on that. The last but not least is accounts payable. You pay your vendors. Cost of goods sold divided by accounts payable, 3.9 in days, 94 days. You want that day as long as possible so you can pay your supply a little bit later, okay? Asset turnover ratio. Sales divided by total asset. In this case, 0.64. This ratio sometimes is called capital intensity ratio. It means, you require a huge amount of asset investment, particularly, for the traditional economy, manufacturing, you have the facilities. Is 1 divided by the total asset turnover ratio. Is 1 divided by the thing, sales total asset ratio. In our case, is 1 divided by 0.64. Is 1.56. Okay. Now you want that ratio, turnover ratio, as fast as possible, right? So many people are avoiding have a huge sum of investment in their fixed asset. They're using outsourcing. They don't subcontract. But there's a strategy move on that. Many of traditional company have intensive, very high investment requirement for their fixed asset. Those are measured. Up to now, we are looking at a measurement. The fourth category is important. Is the profitability measure. I remember there's one student working for BART, someone who lived in Tracy, he mentioned in introduction. They counted the ticket receipts and found they complaining, now the BART or something are not always making me always in the red. There's a reason, because you don't make any profit. That's the problem. If you don't make a profit, you're losing money. Now, there are a couple ratio you need to pay attention to. Number 1 is profit margin. This is usually a trained eye when I look at income statement. I always look at net income first. Make sure it is positive. They're making money, okay? Divided by sales. Very quick mental exercise. For this company, is 363. Is that net income divided by 15.7. What that mean? For every sale, the company's profit is about 16 cents. Now you want the profit margin as high as possible, but the competition sometimes squeeze up profitability. Look at those traditional brick and mortar department. The profit margin is so low, like 2%, 1.7%. Go to online, look at those, serious bankrupt because they didn't make any profit on that. Many, they cannot compete with online profit. Now, from investor, another measurement is called the return on asset. The asset you use is a net income, which is income statement, divided by total asset, which is a balance sheet. How many assets you acquire, the company worth? In this case, is 10%, about 10%, 10.1%. You notice the asset you are using generate 10%, about 10%. But the key element here is not ROA, because the manager really responsible is for making decisions for the owners, the principal. Principal are shareholders. The return on equity, that really counts. How do I calculate return on equity? ROE, net income divided total asset, 14%. Now here is interesting. If the company, this particular company, has 10% on its average asset, why the return on the shareholder is higher, is 14%? That is because they use financial leverage. You pay a fixed amount interest as your cost of debt. All the rest go to shareholders. So in this case, the ROE is much higher. higher than the ROA. Now, ROA usually close studies show the close related with technology. New technology, it has a high rate of return. Check Apple computers. Check Google to what a rate of return. Compare with traditional, let's look at Walmart, Kmart, Sears bankrupt. Look at those ratios are extremely low. But high tech, you demand huge profit margin, right? But the competition will squeeze the profit. So here, we see how the business conducted, how to enhance the rate of return for shareholders. Right. Now, the last measurement are market value. As we say, that book value are usually a history record. It's very conservative, right? But market value, everyday value can be very volatile up and down. This company current stock price 88% per share, has a 33 million share outstanding. Earning per share, NIE divided by 33 million, $11 per share. PE ratio is 8 times. Now this one say that the profit margin is like it's 8 times of the current price. They also measure price sales ratio. Those are also market value ratio. Another one is called the market to book ratio. You look at book value, then look at market value to see is that market to book value is higher or lower. Lower usually, then you have some troubles. The market, if high, sometimes too high, people are worried about. Well, how to justify the ratio is so high? Now those are looking at the market ratio. So we say that when we studied last week, market value is a relevant. Most relevant information, okay? But book ratio also reflect some historic cost. So here is the enterprise value, which is total market value of the stock plus book value of all liability minus cash. They assuming that if you pay, what is the market evaluate, give you the value in addition to cash you hold, right? They also there's a measurement looking at EBIT. EBIT is earning before interest, tax, depreciation, and amortization. Amortization is depreciation for financial debt. So called enterprise value, that 3803 divided by EBIT, looking at, is a 3.93. Now those are different measurement to measure a company's market condition and its profitability. Here is that particular company's ratio. Sometimes it's very hard to. Definitely, the impression is I would say that this company has a very good profit margin. I'll look at the profit margin is something 15.7, very, very good profit margin. It's very good. Right? It's in comparison, and it depends on what industry. If the industrial, the average profit margin is 25%, now this company is not doing well. In other words, you have to measure the benchmark. So not a absolute value, those ratios, right? You have to look at the benchmark. But on the other hand, if profit margin are negative, no matter what industry you are in trouble. For example, Tesla's. Although it's a new industry, but the company financial is really bad for now, right? For now, unless you have plenty of money to invest, to reinvest, otherwise you cannot sustain. Because if the profit margin is not positive, mean you're losing money. If you constantly losing money, as the bar situation, always in red, the pie becomes smaller and smaller. The obligation, if it's constantly grow, then you cannot meet the obligations. You're bankrupt. All right. Oh, here is the financial information from 2014 for the department store, the Lowers and Home Depot. Right. Here you can do the analysis to see what that is. Now, key ratio I'm looking at is profit margin first. Obviously, Home Depot doing much better than Lowers. Therefore, you're looking at Home Depot's return on equity, 68%, is much better than Lowers, 27. Okay, those are key ratios. Now you can compare different companies in terms of its ratio, right? Because the sales, if you look at the sales, a different scale. One is 56 million, one is 83 million. All right. That leads to a golden ratio. I call it the DuPont identity. It's invented by DuPont, the manufacturer of DuPont, chemical product. It gave you a key ratio and its decomposition. DuPont identity identify the element which will determine return on equity, which is return on stocks. The basic formula is NI divided by total equity. That's the basic formula. Return on equity. Now those financial analysts find out you can times a decompose into three ratios, ROE equal to PM ratio, which is a profit margin, times total asset turnover ratio, times equity multiply. Those three ratios. You can decompose the ROE into three ratios. Profit margin and asset use plus the equity multiplier is leverage, which explains, for example, why Home Depot have a better return than Lowers. Now that is the DuPont ratio. As an investor, I pay attention to the DuPont ratio. As a manager, general manager, you also pay attention to why? Because the management are measured by the company's return on equity. If you're constantly losing money or not doing well for shareholders, people will replace you. Now let's look at the DuPont identity. It's a basic form and expanded form. Let's look at the expanded form here. PM profit margin. You look at this company profit margin, the measure for company's operating efficiency if you have high margin. The other thing is, how do you control? So is that Home Depot they can buy they have a better sources for the supply than Lowers? I don't know, but this is one reason looking at why Home Depot is doing better than Lowers. Next factor is total asset turnover ratio, which is the measures the company asset use efficiencies. How many warehouse, how many store space you need to maintain, how well does it manage its asset? Right now, if it's a positive, this high value, then return is on equity will increase. Last but not least, do they effectively using financial leverage? Does Lower do not using debt, or Home Depot using more debt? It depends. It depends on the situation. On those are three aspects you can do it. You are checking why the company doing well compared to the other one. Is looking at their detailed identity. Now those DuPont identity give you detailed clue to check company's operation, the company's profit margin, and the company's financial leverage. You have to use it. So when doing analysis of a corporation, obviously the most important key is a return on equity, not the return on asset, by the way, is return on equity. Right? Now, you're looking at why this company doing better than the other company. You're looking at those three aspects. So for this sample example, return on equity is profit margin 15.7 times 0.64 times 1.38, so 14%. Remember, what is the return on asset? It's about 10%. See that? Return on asset is 10.1. That means, using particularly the leverage part and high profit margin, will become 14% return. 14% return. So Pont Identity is widely used in financial analysis. There are so many ratios. Where you start? Start the key ratio, return on equity. All right. Lastly, we will do is about the growth rate. People always think, we need a growth, high growth. So, but you need to be careful on how the growth. Sometimes the growth is not manageable. Let me give you two benchmarks you need to know, particularly when you write proposals of you apply a business proposal, business plan to say, we're going to start a new business. Every year our sales will go to 10%, 20%, 25%. Okay. There are a couple of ratios you need to know. One is the dividend payout ratio. Dividend is the money, the profit company making, then paid off to shareholders. The ratio is, dividend payout ratio, is a cash dividend divided by net income. Now, the retention ratio B is the additional retention ratio. In other words, is what the left for dividend pay for that. So EBS minus DPS divided by EPS in ratio. The high dividend ratio, the lower retention ratio. The high retention ratio, the lower dividend ratio. Not every company has to pay dividend. Sometimes people has zero dividend, then retention ratio is 100%. That means all put it back in the company's operation. So in this particular company, the dividend payout ratio is 33%. So every $1 they make, 33 goes to a third goes to dividend paid off to the shareholders. 2/3 put it back in share. 2/3, 66.7, put it back, go to in retained earnings. To the retained earnings. Now, for this company, there's one for growth. We want a high growth, right? What is the internal growth rate? Now, that growth rate give you how much the company can grow asset using retained earning as the only source of financing. In other words, do not using additional debt or equity. You just self-sustain. That terminology called internal growth. You already have the money. You generate the revenue. You put it back. What the growth rate? How do I calculate? Is return of asset times retention ratio divided by 1 minus return asset times retention ratio. Now be careful. You need to follow the order of operation. You need to calculate ROA times B first, then 1 minus that. No, you cannot do like 1 minus ROA times B, okay? That's wrong. The algebra, you need to remember that. Okay, do multiply first, then do addition of subtraction, okay? Orders. So in this case, 7.23. In other words, according to your company operation, if the sale grows up to 7.23, you are okay. You don't need additional fundings. But is that a optimal ratio, growth ratio? No, not necessarily. Particularly, you can borrow money. Then the next one is called sustainable growth rate. The sustainable growth rate is how much the firm can grow by using internally generated funds, and in addition, also using additional debt, but maintain the sustained debt ratio. Your debt, the proportion debt will not change, but raise it. How do I calculate? It's ROE times B divided by 1 minus ROE times C. Here is not ROA. Now, in the internal growth, ROA. In the sustainable growth, ROE. In this case, it's 10.26. You can grow your company up to, the sales growth can be up to 10.29. Anything more than that, you probably have to change. You cannot keep the percentage of your ownership anymore, right? So these two ratios, particularly the sustainable growth ratio, the bank lender will pay attention to it. We know that growth is determined by, number one, profit margin. The more high profit margin, you can grow faster. It's operating efficiency. Part of the reason, if you can cut the costs lower, then your profit margin is higher, right? Second one is total asset turnover ratio. It's the efficiency using your assets. Number three is the financial leverage. How are you using other people's money, the debt? Or the dividend policy, sometimes if you're a high growth company, startup company, they pay no dividend. Everything put it back to investment. So the growth here will be determined by a lot of factors in it, right? Now let's look at that particular DuPont analysis for Yahoo and Google. For the year from 2012 to 2014, obviously Yahoo, the ROE is not very good. At 2014, it's less than 1%. It's 0.4% a percent. 0.4%, I'm sorry. 13 is 4.5, 3.9. Now let's look at Google. Is 16.1, 15.3, 13. They all go down, but if you're looking at the same year, you find, wow, Google is much better off. Investors in Google much better off. Why? Now look at the detail. Profit margin. Yahoo has a low profit margin, and the profit margin getting worse. 2013 is 12.6. 2014, 3%. There's no profit, almost close to zero. On the other hand, Google have more than 20% as profit margin. Turnover ratio. Also, if you're looking at a turnover ratio, is very, very low. Use a lot of asset. Equity multiply. Now this one, see, you will find out Google use higher financial leverage than, I'm sorry, Yahoo using high financial leverage than Google, 1.6. Right? Although it's improves their return on equity, but getting riskier. They have to meet those debt obligations. As we know, Yahoo is now closed, right? Is not doing well. This one just show you why financial statement evaluation is important. Internally, it's a performance evaluation. Many executives' compensation depend on return on equities. A return on shareholders. And you're also looking at the different division comparison to see the how they're doing. And also is a planning for the future. Which department is the weakest one? Which department is strong one? Strong one we reinforce the weak one. We need to really improve it, right? Externally, from creditors, from suppliers, they will be more interested in short-term solvency, quick ratio, or cash ratio even. Or even customers want to look at. If the company will still there, you buy a product. If the company a couple of years later, the bankrupt. Sometimes Tesla. I had some friend bought Teslas, a very expensive car now. I was thinking to get one, but on the other hand, I hope I have the company still there after 5 years. You never know. If their profit margin is constantly negative, no. Obviously, shareholder need know how the company is run. They have using financial ratios. Ratio, there's no standard, clear-cut, good or bad ratio. Everything, relatively speaking. So benchmarking is important. Who do you measure against? Ratio need to be compared to something they use multiple years. The we is use multiple years. Don't give me just a 1 year financial statement. I need at least 3, 5 even better. Multiple years. So you can see how the company performance is changing through time. Getting improved or get deteriorating. Right. Peer group analysis. You are looking at not only looking at lowers. You want to looking at Home Depots. And then lately I have our neighbor hardware store, Orchard Hardware, bankrupted, right? You're looking at what their ratios statement. Obviously, they don't have enough money to pay their debt. They're totally liquidated. So you can compare to within industry. There are standard industry code. You find out what the company you study. You can compare with that. Now, the problem with financial analysis is now the company is complicated, not readily available to compare. For example, Apple. Is Apple a computer company? Obviously not. A telephone company, like HP. HP used to be a printers, right? Or computers, or medical equipment. Now, Agilent split Agilent. Sometimes it's conglomerate, so they are in cross board of a different product, right? Global competition, you have all the branches, so it's very hard to compare one with the other. Now, with the international company, the different accounting procedure, international standard is different than the GAAP standard. General accepted accounting standard in the United States is different than international standard. Some companies have fiscal years ended with like calendar year, December 31st. Some people ended with April the last 30. Some people using high leverage, some people using low leverage. There are some kind of seasonal variation, and particularly there is a one-time event suddenly sell by. Those are what we call non-occurrence expense. When you do analysis, always pay attention to it. It's the outlier. It should not be included in the general analysis. Like a company suddenly they sold their couple of buildings that year, have a lot of cash flow, but that will not occur next year. They don't have many buildings to sell. So when you do analysis, you have to take all those into consideration. Reuters have a website, but my favorite site is still using financial Yahoo Finance. Looking at the highlights and all those statistics, they give you key element. Particularly profit margin. Okay. All right. You can go over with all those quick quiz to see what the concept is. Let me just remind you, you need to work on your Excel. Starting from next week, we're going to working on financial calculators. So this is the only week you have time to work in your Excel. In real world, many people are using Excel. Okay, not financial calculator. However, in the online short-term intensive course, I have to using financial calculator. It's much easier to solve time value money. So you have to have financial calculators next week for 2 weeks. Okay, intensive. That's the most difficult part. But we cover such a wide base and very useful. So please get ready for the financial calculators.